Hello, folks. Brandon Chapman here with you. It's the Thin Night video for May 9th. May 9th? Yeah, 2022. Caught me by surprise there when I said it. The market's fading today. The question is, where have all the buyers gone? Is it the end of buy the dip? That's the big question for today. As we look at the ES futures, you'll notice we finished near the lows of the session. As we get a sense of the cash session, we can take a look at SPY. You'll notice we kind of gap lower on the open. We finished near the low of the session. And if we search back, you can see that we broke below past levels. For example, back on February 24th, a very ugly day intraday, we saw over 90% of volume and issues falling on that day. Volume on those stocks were down. So again, heavy selling day. We are able to rally off of it. I will tell you, things have materially changed since then, but that did establish a very pivotal level going forward. So if you draw your line here, kind of around that 411 area, you'll notice that's where we kind of bottomed there. We closed at that point on Friday and clearly breaking it today. We had similar volume and advanced decline statistics on Thursday and Friday of last week. We recovered off the lows on Friday and finished at about the close, about equal to the low we saw on that day. So we saw similar bad breadth on Thursday and Friday, but we just didn't recover, right? With today breaking through. And in fact, we can take a look at it. If we take the New York Stock Exchange data, so we'll take $DECN, we're looking at declining issues. We'll take $ADVN. So this will be a ratio. So if I bring up the pairs ratio study here, oops, it's not what I wanted. If we bring up the pairs ratio study here on the platform, did it again. One more time. We're focusing on the yellow line, right? So if you bring up the pairs ratio indicator, it's right here, for example. You type in the plus, the yellow line represents a ratio. I'm going to take this to a 5-day, 5-minute chart. And what you'll notice is that on Thursday of last week, we saw, 11 times more declining issues than advancing issues. And then we're able to come in. On Friday, we saw it get as high as around 7, almost 8 before kind of falling back. Today, we opened up very close to about 11 times more declining issues than advancing issues. We got better throughout the course of the day, finished about 7.5. But again, we did not recover. We saw fewer stocks declining by the end of the session, at least by a little bit, but overall, the price of the market did not recover. If we look at volume, $DVOL, that's down volume on the New York Stock Exchange, plus $UVOL on the New York Stock Exchange. Again, you'll notice today we were up here around 35 times above where we were on Thursday, and even Friday that was approached even 15 times on Friday, meaning we saw 15 or today 35 times at one point, more declining volume than advancing volume. And we finished around 13. So again, over 13 times more volume on declining stocks than advancing stocks. This really shows. Now, normally you'd see this would be pointing to a bottoming process. But the problem is, despite the improvement in the advanced decline in the up volume and down volume, we did not really see an improvement in the market at all. In fact, we finished just off lows at around 3.2%. A little note from Morgan Stanley saying, hey, we're seeing more at the moment. We're seeing the most outflows from retail investors that we've seen in literally years, potentially going back to 2016. And so what we're seeing is the retail trader is getting fatigued by this, and they're selling into this strength. So we're selling into this market versus buying the dips and looking at it as an opportunity. The poster child of this obviously is the ARK funds, right? Normally they saw big inflows here in the last month. Again, did not materialize in terms of actual strength. And you notice today, for example, is down 9.86%. Again, these technology stocks are under significant stress. When you look at the areas of strength in the market today, just look at today's percent change. Staples were down marginally at 0.04%. Energy down 8%. That was the best performing sector last week, up nearly 8%. However, look at technology in here, for example, down nearly 4%. So again, you're seeing cyclicals, you're seeing technology, you're also seeing real estate get hammered as well, which makes sense. Now, conversely, when you look at stocks that are down today, Lowe's and Home Depot did relatively well. So for example, Lowe's today, a nice engulfing formation, closed near resistance at around 197. Home Depot, very similarly. But again, the important point here, and I've tried to say this week after week, is the risk is to the downside. So maybe a little short covering today in these names. Home Depot has earnings coming up on May 17th. You look at Lowe's. Lowe's has earnings coming up on May 18th. The point being is that don't get lulled to sleep. These have just recovered back to resistance. They're still below where they were a week ago. When you look at energy, again, look at where we were a week ago. 1, 2, 3, 4, 5. We opened last Monday, for example, at 74.71. If you recall, we were looking for energy and energy stocks to retest prior highs. So again, we're only getting ripped back to those points again. Maybe we can stretch down to 72, maybe even 71. Now, here's the risk with regards to energy. We're not going to get out of the woods in terms of supply. The only way out of these woods of high oil prices is really through attrition, meaning what? Recessionary pressures. And that first quarter negative GDP print largely a result of a lack of exports. Our trade balance subtracted about 3% off of GDP. And then you've got the inflationary pressures subtracting from it. There's a good chance we end up with negative GDP again, potentially, right? As these pressures may not abate. Point being, though, energy may have some downside to these areas, but you're going to see opportunities where people start to pick it up as long as this. So we go to the product depth chart here. We're looking at today's current term structure graph here of the future prices as we go out to future expirations. We are in backwardation. The yellow line was 2 weeks ago. The blue line was a week ago. So we're not quite as steep as we were a week ago in terms of oil futures, but we're pretty dang close. But we are steeper than where we were 2 weeks ago. Meaning what? It just implies there's even more of a shortage now than 2 weeks ago, maybe a little bit less than from a week ago. And again, the shortage will only be solved with the lack of demand. So again, do you believe in the demand destruction of oil? If you do, then maybe you are going short here. But the point is it's going to be very, very difficult for the market and oil stocks to move significantly higher without some sort of supply shock, which is still a possibility, which is exactly why oil futures are in backwardation. So you might take some of these opportunities as energy rips back towards support again. And we saw that with MRO today. So MRO was down 14%, back again now near support levels. Now, earlier in the session, you did see some bullish activity crawl out of the woodworks for a 3 June expiration here. Upside here, ended up selling a bit more calls at the 30, but buying the 28 and selling the 30. Again, pointing to some potential upside. So it's probably put on net for maybe a small credit possibly, but the idea being is a relatively neutral trade. Expect this stock to maybe get back towards 28 or 30. And again, we're kind of setting up now close to support. So you might look for the price firming up in this week and maybe starting to reverse. But the point is that, again, this is the one area you could probably go back to and look for opportunity. When we think about other commodities, well, what about gold? Gold's in a different position right now. Gold supply and demand doesn't really change with cycles, right? It's pretty consistent in terms of production and demand, for example. And as a function, what gold is responding to today is the fact that the dollar is strengthening intrinsically. Now, you can look at UUP and see how it's relating to euro for predominantly. You know, this is about 57% weighted to the euro/USD, inversely related, which right now we're in kind of a bear flag here or a bull flag on UUP. So the dollar didn't gain a lot of ground against foreign currencies, but it did intrinsically strengthen as we saw gold decline here. And this is the risk to the downside. If the dollar strengthens, gold will go lower. And by extension, so will Bitcoin. So you can say, well, what about inflation? People keep raising this inflation boogeyman as if prices of goods are really relevant in terms of inflation. We have redefined how we define inflation in the last 50 years. When we think about inflation right now, we're thinking about consumer prices. What we're not thinking about is the money supply. Okay, so we think about gold and Bitcoin as being hedges for inflation. What we're talking about is not consumer prices. We're talking about the money supply, since Bitcoin is priced in dollars, since gold is priced in dollars. Right now, with the Fed raising rates and expected to aggressively raise rates in the near future, reduce the balance sheet starting June, what we're seeing right now is the money supply is expected to contract, which means the dollar should gain in value, and which means that Bitcoin and gold are in trouble. And Bitcoin has the added impact of the fact that there is a lot of leverage in Bitcoin owners. Someone shared a stat today saying 40% of owners of Bitcoin are underwater. Okay, maybe so, but the point is, it's not going to be the store of value that you think of relative to consumer price inflation. Because we're not producing things, consumer prices will continue to go up, whilst Bitcoin may continue to go down and gold may continue to go down because the money supply is contracting. And this dichotomy is something that Powell has talked about many times, right? They can cure the money supply problems, but they can't cure the imbalances that their policies have caused by outsourcing production to emerging markets and diminishing the dollar. And again, creating this environment where we just don't produce enough in the United States. We emphasize debt over savings, et cetera, et cetera. So remember, Bitcoin has more downside here as a result of why? Increase in the money supply and a deleveraging that has to happen in order for Bitcoin to find its footings. Now, eventually, gold and Bitcoin will have their day in the sun, and especially gold, as it does have a wider adoption. Bitcoin has gained adoption, but we got to see that kind of excess or leverage in Bitcoin start to diminish that is created by the futures market and other trading platforms, trading with leverage. So as we look at this broader market, again, we broke a key level of support today. Yes, it was ugly. Yes, the breadth was weak by historical standards and sometimes weak enough to maybe start to see some upside here. But remember, look at the VIX today. The VIX did not even take out the high from May 2nd. Right? I mean, this is interesting, given the fact that what does this say? It's telling you that institutions are relatively delta comfortable. What does that mean? It means they're hedged, right? We've had several volatile events, and right now what we're seeing in the market breaking support, it was not much of a surprise to the market, maybe anticipated, and the breaking of support maybe was just the void of retail traders coming in to lift it up again. And again, remember, with that in mind, there is potentially more downside. So again, we're going to have to see greater selling pressure before we start to see the VIX really pop here. As we look at the volatility or the VVIX, it's only at 125. We're not spiking to prior levels around 140 to 150. Again, there is not the panic in the streets. So we're seeing bad breadth, largely a result of maybe retail selling. The institutional side's been selling all along, and they've also remained hedged. So again, we're not seeing that capitulation on the volatility side that says, hey, we're really poised for a big rally here. We look at the 3-month VIX to the VIX ratio. Again, are we seeing backwardation? Are we seeing this below 1? We're close. We end up closing right about 1. Now, if we go to product depth here, we look at forward/VX. Question being, are we in backwardation? Yes, we are. Take the first two contracts here, 33 and about 32.50. We'll just kind of round it off here to about 32.75, 33, and we come back to the VIX. Where's the VIX right now? It's about 34.75. So the VIX is in backwardation. The VIX futures are pricing a little bit of a discount. And I guess the 3-month VIX to VIX ratio is not perfectly representing this. It's pretty close. Point being is that what? I mean, there may be an opportunity for the market to move higher. But remember, moving higher means we may get a couple of day rally. We may test that 411 or 4110. If we go back to the SPX here, what was the low? There was around what? 4115. So maybe get a little short-term snapback here. So again, but remember, the buying the dippers may not be materializing. They didn't materialize today. They may not materialize tomorrow. They will eventually, but may only provide that short-term lift that is really just provides a great opportunity to fade. So that's kind of from a bigger picture perspective. But when you look at some of the areas here that consumers rely on, one of those is debt, right? Credit card debt. Just anecdotally, it seems like credit cards debt is being accessed more by consumers to deal with higher prices. We know that our real kind of income, our cost of living has been running at a negative for many, many, many years For all intents and purposes, we've required debt to maintain our standard of living. And again, now we're looking at maybe Discover Financial Services. They have their own card. They're also their own bank. They're holding on to balances. Is there the possibility that we might start to see consumers stretch themselves and may put themselves in a bigger position to potentially default? As we look at JP Morgan, one of the reasons why they lost money was a result of setting aside more money. I say lost money, but missed estimates was setting aside more money for loan loss reserves. As we look at DFS, they already announced earnings. We signed a nice little pop that ultimately stalled out very quickly. We're seeing the downside here. But if we start to take out support, there's a potential for a big decline here in the price of this stock going forward. So we draw kind of our fib retracements here. Certainly 92, very possibly maybe stretching to 66. Again, certainly the power of the weight of these down moves may reasonably carry it to some of these levels, maybe down towards 60. Now today in DFS, we did see some bearish trade materialize. This was for a July expiration out here, and it was a 180 strike price. So if you're buying the 46% implied volatility and selling the 60%, that's beneficial, right? The skew is adding some edge to this trade, minimizing the risk, accentuating the potential reward. Certainly, is there a high probability of getting to 80? No. But again, you don't need it to very often for that thing to really pay out. And $80 happens to stand at about the 50% retracement. We didn't see it just in DFS. It was also Capital One Financial, similar companies. Again, they don't have the processing side for Capital One. I believe they use Visa, but they are the banking side of it. Again, the potential loan losses, etc. Start to break here. Can we reasonably see 187? Absolutely. You look at this kind of first leg down here, measure this. Could we get down to 87? Absolutely. Could we get down to 37 towards the COVID lows? That's a very real possibility if we truly are entering recession. We do see support here at about 122. We start to take out these lows. There's very definite downside in companies like Capital One and Discover. This one was a June expiration, and again, was buying the 120 and selling the 95. And again, not even challenging these lower points here, but again, 95 stands about right here, certainly breaking towards that 61% retracement in Capital One. But remember, is the skew favorable? Yes, you're buying 47 and selling 63% implied volatility. There is edge here. There's a minimal cost and high reward. 25 point spread costing maybe around $5. Not a terrible deal. Again, 4-to-1 reward to risk. So you don't have to be right up. You have a little bit of time for it to get there. So again, what we're seeing here is that the weight of the consumer, both on the buying of the market and today seeing some bearish trading in a couple of consumer stocks, Capital One and Discover Financial Services. Again, looking for some downside here in the next weeks to maybe a couple of months. And it wasn't just here. We talked about Emmer on the bullish side. Let's look at ABNB. So Airbnb. There's been a lot of optimism that somehow that the travel is going to come back despite higher gas prices, etc. Airbnb has been struggling for a while in terms of the price action, but we were able to find support several times about 133 down to maybe 130. Today that broke. The company did announce earnings about a week ago, missed estimates, and again, are we going to see the same travel? Again, our Airbnb, we're going to see. But again, we saw a loss posted that also, beat estimates, resulted in the stock declining and further selling. This may not actually be accurate. Oftentimes it's not. So got to provide that caveat there. But we did see the price break support today. We've not experienced this. What happens right now? Do we start to see people that bought it in the IPO begin to sell it now? We may start to see that. And again, so we're seeing ABNP decline today. It was a 3 June expiration out here. Looking at the wrong one. Sorry. 13 May expiration at the 130 strike. So it was actually in the one I was looking at was in the money here. Sorry. I'm looking at the wrong one. Let's come down and look at it. It looks like we were kind of being rolled down. I may have looked at the wrong expiration. May have written it down wrong. Looked at it earlier today in my session, but anyway. So we got the 120 in here. Selling at 115. It's going to be mixed here on the put side. Let's go back to that 130 strike again. Looks like we're probably rolling down. We can isolate specific strikes. And I'm sorry, this is bad TV right now, but thought I looked at this before I jumped on. Apparently I either didn't or I missed it or something like that because my notes are throwing me off here. So we'll stick with 13 May. And let's just isolate the 130 strike. This is going higher too. So it looks like we're probably mostly bought at the 130. A lot of it's occurring between the market. Let's roll it down to one of these other strikes. We had a 120 in there as well. The issue with the 130 is that certainly we have a high amount of open interest. Apparently I did not check this one as much, but I'm just scanning here. It still looks like mostly buy-side activity, even at the 120. It's a cursory look I'm taking here, but then we got 115 way further out of the money. So again, kind of a mixed bag. I thought it was more definitive when I looked at it earlier, but yeah, probably looking like we're again, looks like mostly buy-side activity across the spectrum here on the puts that are very short dated options here for May. And again, just reflective of the pressure. There's probably maybe even some intraday rolling down to lower strike prices as it began to break. Unfortunately, I don't have time to look at it. Don't want to spend a ton of time doing that. But we can also look at NCLH. Norwegian Cruise Lines did not exactly break support per se, but we're getting very close to a key level. We did break some support up here at around 1775. Again, let's look at that 13 May expiration. We got the out of the money 15s here. Again, probably closing some of the in the money, moving it out of the money. But again, the idea is mostly buying in the out of the money 15 here. Just reflective of just some general bearish sentiment. 15 is not super far away. It's at about the support there, but just reflective of today's conditions. NUE is another one. This is I believe it's if we look at the Analyze tab here, go to Fundamentals, type in NUE. You can see what kind of company is, materials. It is a steel production company. So as we go back to the trade here on NUE, this is one that saw a significant breakdown last week. We're continuing to see the down day here. As we look at the retracement, certainly reasonable that we might get back to that kind of $94 area. And what you saw today in NUE was actually a shorter dated expiration here for May, buying the 125, selling the 110. So again, very likely closing out the 140, rolling it out to a 125, 110. Again, we're looking at 110 being the downside. That's your 223% projection, and that's in really the next couple of weeks here. So again, we're looking for downside potential here. One last one we'll look at is CLF. Again, this is an iron ore producer. Big down day today, nearly 8%. This just shows you how to trade this kind of stuff. So if we look at Cliffs, this is actually for a June expiration. Yeah, sorry, this was a bullish one. This was a call roll down from the 30 down to the 27 strike. So as we're seeing the price fall, we're seeing buyers chase it for Cliffs, looking for upside in iron ore production. We've got NUE, that's a steel producer and that sort of thing. So we're seeing it just different areas. Sorry, I kind of messed this up today. But anyway, what you're seeing is a roll down from 30 to 27 with the optimism maybe we start to shake out here in Cliffs and start to see it rise. But the realities, folks, is that we look at bearish activity in Alcoa. Generally speaking, the industrial metal space is showing some weakness, as well as industrials in general. In fact, it was last Thursday in my session, I called out there was a trade at the July 95 strike on Thursday. Price was probably up a little bit higher here. We've actually broken through 95 today. So the industrial space, seeing a lot of weakness. And we think about industrial metals or processors like a Nucor, for example, Alcoa on the aluminum side. But then you've got your Cliffs, which is more on the iron ore side. So if you come up here, go to Fundamentals CLF, you'll get kind of a producer of iron ore and steel products. Whereas we look at NUE, manufacturer of steel and steel products, a little bit more downstream. It's not benefiting from the higher oil prices. They're buying the ore to convert it to steel and steel products, which is where you're seeing a lot of the costs there as well. So the higher iron ore costs will be reflected there. Anyway, so we've got a very interesting market of a weakening consumer, a lack of stepping in at every turn, buying the dips. We're probably going to continue to start to see more outflows as we start to see a more despondent retail investor. As we can see right now, institutional traders largely are, again, we're seeing outflows as investors are pulling money out, but they're largely hedged. We're not seeing the panic and we're not seeing the volatility spike as you would normally do, even on a day like today where the breadth was really seriously bad. So again, it just calls into question the near-term possibilities. Certainly, we're oversold enough to see a short-term rally, but as we get back towards 410 and 411, be weary as we get back of there. Again, providing an opportunity to go short again, or possibly, again, if we extend to the downside here, some of the energy stocks may set up for a near-term bounce. Anyway, it's great to be with you today. We'll see you back.